Do you know that one of the reasons why your deal might not be penciling out might be because of your debt or your funding or how you intend to finance that deal? The financing of a deal plays a long role in making your deal profitable or penciling out. Yes, it does make that happen. So today I'll be discussing about what exactly is capital stack and how you can structure your deal, and also the pros and cons of becoming over leveraged or under leveraged. So what are those things that we should be looking out for? First of all, what is capital stack? Capital stack is a structure of just how you finance your deal, and there's typically 4 different stages, although you can decide to structure your deal as it deem fit. But just take example, look at a pyramid, and the baseline of it, you find senior debt. The senior debt are debt that comes from either a bank or even the government, like Fannie and Freddie. They typically have a low interest rate and they are low risk to them, and the property becomes the guarantee of the loan. And if anything happens to that property in terms of maybe they are not able to pay their debts and all that, the property is taken as collateral. So in a capital stack, they are the first ones that get their funds before any other stages can get theirs. I guess I forgot to mention that it is typically between 65 to 75% LTV. So what that means is that the lender is willing to give out, let's say a deal costs $10 million. The lender is willing to give between 65% to 75% of that purchase amount of that property. So the property costs 10 million. The lender is willing to give between 65, that's 6.5 million to about 7.5 million of their money as them financing it. So the remaining 25 or 35% as remaining on the debt, you can also structure it in such a way that your equity at the end of the day will be very little. So what is the next structure or the next kind of funding that can come after a senior debt? Some people use another kind of debt called mezzanine debt. So what is mezzanine debt? It's a debt that comes after the senior debt. It's medium to high risk compared to the senior debt that is low risk. This is medium to high because they don't have that kind of guarantee like the first debt. The senior debt, the rate is typically higher than the senior debt because of the risk involved in it. The LTV that they normally give for that is between 5 to 20%. So it just depends on, one, the appraiser, what the value of the property comes out to be, and it depends on their comfort level and what they are willing to do, and also your net operating income. So if the deal is performing well, the probability that you should be able to get more from a mezzanine debt is higher than when your property is not performing well, because if the property is performing well, that means the value of the property has actually increased. So the mezzanine debt, you can use that to fund your deal between 5 to 20% of purchase amount after the senior debt. So how is a mezzanine debt secured? A lien on the ownership interest of the property. So for example, if there is a foreclosure or there's a default in payment, the mezzanine can decide to enforce the lien on the ownership interest of that property and start managing the property. Unlike the senior debt has the property as a collateral if anything goes wrong. These things I'm mentioning, it's not compulsory you use them. Some people just use the senior debt and raise common equity. But if you want to understand the entirety, how you can make your deal work, it's important that you know all these things so that you can know when to use any of them. So the next on the capital stack is preferred equity. The preferred equity comes after the mezzanine debt. It is high risk. Typically, they don't have lien on the property, but they have a guaranteed or fixed returns. That is, their returns is guaranteed compared to the common equity. I'm going to explain the common equity shortly, but it's a guaranteed returns that they have. It's above the common equity, just as I mentioned. And also, they typically get their preferred returns between 6 to 12%. That's the standard. Although I've seen a lot of people going way and above that amount. I've seen 18, I've seen 20% preferred equity. You can actually structure your deal as it suits or based on the cash flow you're getting and all that. So that is preferred equity. It has a lot of risk and all that, but they have fixed returns compared to the common equity holders. The next on the capital stack is the common equity. I think that's the one everyone is familiar with. That is the equity from the syndicates, from maybe limited partners, from the GPs. So any equity that is from the investors like LP, limited limited partner investors from the GPs, co-GPs and all that, those ones can be classified as common equity, or maybe even from the sponsor and all that. So they can all be classified as common equity. So in this case, in the common equity category or structure, it is the highest risk and it's not guaranteed. So under the common equity, the investors own a portion of the property and are entitled to some portion of the returns that comes out from the property. In terms of returns, they own the highest compensation. Let me explain what that means. That means they are entitled to cash flow appreciation. That means at sale or refinance, they get a good portion of it after all debts are paid. And also, they also benefit from tax depreciation and bonus depreciation and all that. So they actually get the highest benefit if everything goes right, but is the riskiest. And in terms of liquidation, they are the lowest. So if something happens, they might end up not getting anything. So for example, there's a deal that I'm aware of that they actually bought for 15 million and they took a bridge loan on it and they've not been able to stabilize the property and the bridge loan is due. So they actually have to sell. Currently they're under contract for 10.5 million for a deal that they bought for 5 million. Right now it's just two structures that are on that deal. That means that deal has just the senior debt and the common equity. So in this case, the entire common equity has been swallowed up. Everybody that invested in form of common equity, they will not be seeing their money. But the lender, the exact $10.5 million is the exact money owed to the lender. So the lender's money is guaranteed. So that is why we say that the senior debt has the lowest risk, whereas the common equity, yes, they have the highest returns looking at the entire scenario I just painted out. But if anything goes wrong, they might not get their return. So that's why it's also very important that you know who you're investing with and who you're giving your money to, because that common equity is the lowest. But how can limited partners ensure that their returns is secured? That can be in a situation whereby the GP team or the sponsor team decides to give a pref returns to the LP partner. So for example, an LP partner decides to invest $50,000 as common equity, but the sponsor can go one step higher and say, yes, you're giving me this as common equity. I'm going to pay you 7% preferred returns. In that case, that has moved the LP's money to something that is kind of guaranteed after the senior debt or mezzanine debt have been paid. Once those have been paid, the next on the capital stack is the preferred equity. That must be paid. And that will lead me to the water flow structure. I will not be discussing about that today. If the LPs are not paid in year one, because these are annual payments. The preferred returns are actually paid annually. But what if something happens and you did not make profit as the owner of the property? Is it that the limited partners won't get their money? So there's a way around it where these things will be deferred, but at the time of sale or refinance, it must be prioritized above any common equity or any profit distributions. The next thing I'll be talking about is the pros and cons. Yes, it's interesting or very good where you are taking leverage. Everyone is happy because you're bringing a smaller amount for the common equity or as your down payment. For example, let me just put this into the right perspective. I have a purchase price. I'm buying a property for 10 million. The senior debt on it is 7 million. That means I have $3 million to raise. Let's assume I cannot raise a $3 million. I can decide to look for a mezzanine of 1 million. The senior debt is, we might be at an interest rate of 5.5%. Then I decide to get a mezzanine, and the mezzanine now comes with an interest rate of maybe 8%. Because of the slightly higher risk than the senior debt, the interest rate is always higher. So I take a mezzanine of 1 million at 8%, and I get a preferred equity partner also to give me another 1 million, maybe at 12%. Then the remaining money to bring down for payment now becomes 1 million. So I now raise that 1 million for my limited partners and for my co-GPs and for myself as the guarantor of the deal. I raise the 1 million and I bring it to the deal. So that is a perfect scenario of what exactly I'm talking about. So looking at this, it looks very interesting. And for a deal like this that is worth 10 million, I'm only bringing in 1 million. Maybe out of the 1 million, only 50,000 or 100,000 is actually from me. It looks very interesting, but you also need to understand the implication of that. What are the pros and the cons of taking lots of leverage and what that can do to your cash flow? So I'm going to discuss the pros of structuring your deal in such a way that maybe you are over leveraged? What are the pros to it? Some of the pros to this are increased return on investment. So you're putting down 1 million on the deal and you have actually control of the property and you have the ability to make better returns because you're putting in low money. Another benefit is tax benefit. So interest payment on debt are tax deductible. So because you're paying a lot of interest rate, all the interest you're paying actually tax deductible. This can help you increase your cash flow, can help you increase the profitability of the property. So these are one of the pros to it. Another benefit is capital efficiency. That means investors can actually deploy their funds into other things, maybe spread it around because they have access to debt and all that. So in that way, they are efficient. They're making their money work for them efficiently and all that. So that is another pro. Another pros is inflation edge. So maybe your senior debt is fixed, maybe because you have them at a fixed rate. Even when inflation happens, the cost of rent on anything might go up. But because your interest is fixed, you are actually against inflation at that point, and that makes you more profitable. So as the value of the property keeps going up, it does not affect your interest on that property and all that. So we're seeing that happening in real time because values of properties have gone up, rent has gone up, many things have gone up, but we are still paying the same interest rate we've been paying for many years. We're still paying that. So that is another beautiful thing about having to do this. So now let's discuss about the cons of being over leveraged. You need to understand that being over leveraged can lead to reduced cash flow because you're paying out a lot of interest. Some of them are with principal. You're paying principal and interest, especially for the senior debt, and the rest you are paying some form of interest. That will reduce the cash flow, and in that way you might not even have enough to go to the common equity, or you might not even have anything to go to the common equity partners and all that. Another cons is higher risk of default. So the more debt you have, that means the more interest you have to pay. So if the property is underperforming and you're not able to raise the cash flow to pay up the debt, and then you might be open to default, and you don't want to do that, and that can lead to foreclosure, and that can lead to affecting your integrity and all that. So you need to be very cautious when you're becoming over leveraged because it can lead to a default if care is not taken. Another cons is exposure to interest rate risk. On the pro, I said if it's fixed, that you have the ability to hedge inflation. On the reverse, which is a disadvantage, if it's not a fixed debt, that maybe your senior debt is a floating rate, the cons of it is that it will keep increasing your interest payment and your cash flow will shrink, and maybe you might be even be paying out of pocket because it's a floating rate, that is variable rate and all that. So in a situation where you have that, that will actually affect the profitability of your property. Everything I've said is not limited to this, but the last but not the least that you need to put in mind is the potential for negative equity. What does that mean? It means that in a case whereby the economy takes a downtime, like what we saw happening last year, even this year, the economy was taking a downtime. Or I think since 2022 to date, the economy has been taking a downturn. If that happens, it has a potential of reducing the value of the property. That is, it might lead to maybe the loan that you've collected might be higher than the value of the property. We saw that happen in real life recently to many properties. The debt that they took was actually higher than the profit because property was not performing well. The economy played a long role. Interest rates went too high. Some people's deals were already due to exit, meaning that maybe they had breach debt that was 2 years or 3 years and they need to refinance or sell at that point. We saw that happening, that many of them could not even sell or refinance the property because the economy had taken a downturn and the value of the property has reduced compared to the loan. So we saw people doing a lot of cash calls. That is, they were bringing in money instead of, because when you're refinancing, your hope is that you're going to do a cash out refinance. What does that mean? It means that you want to pull out money, your equity, money from the deal, not you putting in money. But we saw people, instead of doing a cash out refinance, we're seeing them doing cash call calls to investors to bring in more money. So when refinancing, because the property was not up to the value of the debt and all that, they had to bring in more money to make it more valuable. So that is the implication. That's one of the potential implications of being over leveraged. It can lead to potential risk on your equity. That is, the value of the property might be less than the debt you have on it. So you want to be very careful about that. So one of the ways I advise people to do is not to be over leveraged and at the same time not to be under leveraged. Look for that sweet spot where you can be that you are kind of safe and your risk is reduced. You can easily pay your debt, especially when your property is performing well. In all these things I've said, there's a role for asset management and there's a role for a good property manager. So if you have done your job, you followed all the fundamentals of multifamily, you have a good property manager, you took a fixed debt, you're not over leveraged, your property should be able to do well and do fine. But it's important that you understand the capital stack so that you can be able to structure your deals that can make it more profitable for you and apply them, but not to the detriment of killing the entire deal. I hope you've enjoyed this. And if you are not subscribed to my YouTube channel, which is Blue Ocean Multifamily Group, what exactly are you waiting for? Or if you have not joined our Facebook group, which is Blue Ocean Multifamily Group, just pause for a while and go there, search for Blue Ocean Multifamily Group. All you need to do is subscribe, like, follow us, and you can get more of this content there so that you can continue on your financial freedom journey. I hope you have a wonderful day.